Hey everyone, Charlie here. We're running a quick survey. We want to better understand who our listeners are. Do me a huge favor and fill out that survey. It takes under a minute, and the link is in the show description. This helps us make better content for you. Thanks a ton for listening. Link in the show notes. Today on Bitcoin Season 2, we are going to tell you how the Bitcoin treasury scheme will unravel and create the next bear market. Today, we are the architects of the next Bitcoin bear market. Welcome back to Bitcoin Season 2.
$50 million in subprime loans. How much money could be out there betting on it in your synthetic CEOs and swaps right now, tonight?
Let's see, 50 million, $1 billion.
What? How much bigger is the market for insuring mortgage bonds than actual mortgages?
About 20 times.
If the mortgage bonds were the match and the CDOs were the kerosene-soaked rags, then the synthetic CDO was the atomic bomb with the drunk president holding his finger over the button. It was at that moment in that dumb restaurant with that stupid look on his face that Mark Baum realized the whole world economy might collapse.
And there you go. There's the cold intro hook, that scene from The Big Short, where Steve Carell's character puts the pieces together that everybody's leveraged to the tits and it's all going to collapse. So, how does this relate to today, Colin?
Because we are talking about Bitcoin treasury companies, Charlie. Now, I know listeners are probably hearing this and saying, can't really equate the mortgage bubble and the great financial crisis and all of the CDOs and rehypothecation of those assets and those mortgages. You can't compare that to Bitcoin treasury companies. But there are lessons to be learned in financial bubbles in general. Obviously, the great financial crisis and what precipitated it is much different. We're not on here claiming the Bitcoin treasury companies are going to cause the next financial collapse. But we are going to...
It's so that we can get you to listen to it, because this is, again, us armchair quarterbacking this, and nothing we say is financial advice. But at the same time, we want to cover our bases.
We do want to cover our bases. And so we're not implying that the Bitcoin treasury companies are going to collapse the economy, but we are going to make a case to steelman the steelmans for why these are good, steelman the cons for some of these companies and how they have some unsettling similarities between the investment trusts that blew up and the 1929 market crash that precipitated the Great Depression. So we'll be going over that, going over kind of what an unraveling for these Bitcoin treasury companies would look like and what that would look like for Bitcoin in an event of an unwinding. Maybe a good place to start, Charlie, unless you had anything else, is to start with this essay.
Yeah, this is an essay that I saw retweeted by Nick Carter, who's a treasury company critic. And it's a great essay from the B Water Substack called Bitcoin Treasury Companies Lessons from the 1929 Crash. And it's the third part in a 3-part series. And this describes financial alchemy going on leading into the 1929 stock market crash and then global depression. And there's a lot of similarities. But I will let you kind of lay some exposition.
Yeah, so this is a really interesting essay from B Water, and basically it looks at the investment trust bubble in 1929, which was a part of a larger credit bubble that fomented the Great Depression. And he uses that as an analog to discuss what we're currently seeing with Bitcoin treasury companies. And a key part of his piece that I think is pretty insightful is that when we talk about this comparison has been made before, and when we talk about historical analogs to contemporary events, people like to nitpick details and say, well, actually, these are structurally different than those investment trusts. So some of the pushback that you might receive if you made this argument to someone who is very pro Bitcoin treasury company, they would say, well, these don't have management fees like those investment trusts did. The reporting is much more transparent because all of these companies doing this, most of them, or the ones that are capitalizing on it, are publicly traded companies. So they have to report to their regulators or to the SEC if they're here in the US. They have to disclose buys. They have to disclose how they're funding the purchases, all of these other things. And B. Water addresses that in this piece and basically says, you're kind of missing the forest for the trees if you just focus on some of the details and some of the differences between some of these financial instruments versus the underlying market dynamics that are driving them. And his whole point is that we see the same amount of leverage or more leverage, and we see a worrying amount of speculation involved in these vehicles. And historically, as he points out with the 1929 crash, this can end very poorly. So to start, he sets the stage for, also, side note.
Yeah. This is one of my favorite, because we all know who this is. It's our favorite paper Bitcoin influencer, Stephen Lubka, who I hope to have on this podcast very soon.
Stephen, if you're watching this, please come on. We will not bash Bitcoin treasury companies.
We love you, Stephen. Yeah.
But what I love about this is, if you're watching on YouTube, and if you're on audio, then what I'm showing right now is a meme of the speculative attack ore. And the speculative attack here is using fiat financial instruments to accumulate Bitcoin. And this is something that Michael Saylor has talked about. This is something that fanboys of the strategy have talked about. It's just the basic idea of taking debt instruments and other financial instruments and using them to accumulate the hardest asset on earth. But I'm showing this meme, and the reason I'm pausing on this is I just love that we are in an era where you can have very cogent, well-argued, and well-written financial analysis, and then there's just like smack dab in the middle of an article, there's a meme. It's like it's 100% the IQ bell curve meme, where it's like you have the memester on the left and then the financial analyst on the right, and they're just doing the same thing. Anyway, I just think it's great. I find that to be a kind of charming aspect of armchair analysis on the internet these days.
He is the Chad who just replies, "Yes, I am going to use traditional financial alchemy to buy more Bitcoin."
Exactly.
Yes, do that.
So, speaking of financial alchemy, B. Water points out how similarly these Bitcoin treasury companies mirror these investment trusts from the 20s. And in this section here, he has a quote that is the header for the section that says, "Investment trusts multiplied like locusts." I'm quoting directly from the piece here. "The explosive proliferation of Bitcoin treasury companies mirrors that of the 1920s investment trusts, and both gold rushes stem from a perfect storm of greed. Intense investor demand for exposure to scarce assets creates NAV premiums that promoters rush to monetize. If Goldman Sachs could extract enormous profit from its trust in the 1920s, why couldn't everyone else? Similarly for today, if MicroStrategy can monetize its NAV premium, why shouldn't every company follow suit?" And he quotes this document from the time period, or this is an economist diagnosing the time period. This is Galbraith, and Galbraith says, During 1928, an estimated 186 investment trusts were organized. By the early months of 1929, they were being promoted at the rate of approximately one each business day, and a total of 265 made their appearance during the course of that year. In 1927, continuing to quote from Galbraith, the trust sold to the public about $400 million worth of securities, well, obviously a lot more in today's dollars. In 1929, they marketed an estimated $3 billion worth. This represents at least a third of all new capital issuance in that year. And by the autumn of 1929, the total assets of the investment trust were estimated to exceed $8 billion. That increased approximately 11-fold since the beginning of 1927. But Colin, these investment trusts, they weren't backed by the most pristine, hard, digital bearer asset in existence.
Yeah, they were backed by backed
by stonks and bonds and other investment vehicles that are very common. So can we really compare the two? Because the underlying asset is just completely different. And I think that that's kind of a facile argument, but some people I think would make it. And that's part of B. Water's point, is the fundamental mechanisms driving the investor appetite into these stocks is not any different, because it's fueled on speculation and the desire to get exposure to these vehicles, and people are paying a premium for these investment vehicles compared to the underlying assets that they hold.
Yeah, I mean, you're right. I mean, so first of all, yes, I 100% think that Bitcoin is way different than stocks structurally long term. But I will say this, like if we are, a lot of the assumptions that Bitcoin will continue to increase by some like minimum threshold year after year, maybe not linearly, but on average on a long timeline, stonks have done very well since 1929. So it's like, it's not, the problem was not actually that stonks haven't been a good investment long term, especially if you invest in like the American index. It's really just been that over speculation, and you have these kind of opaque leverage instruments, and then and certain types of long-term corporate debt where the cyclicality of when these things need to like not collapse is very important.
Yeah, and I think ultimately the keep it simple, stupid explanation too, of like it doesn't really matter what the asset is. If that asset is in a bubble and that asset corrects, and you have all of these financial instruments and trusts, or in these cases, equities through the Bitcoin treasury companies, then you risk having all of those things unwind. So the entire thing is levered up. Someone owes someone money down the road. And if the actual assets that are collateralizing this entire venture end up taking a huge haircut, then the entire instrument faces kind of a death spiral, right? Or potentially. And that's what happened with the investment trusts. One thing I want to earmark for probably the tail end of our discussion, as we go into kind of, or at least what I would view as like arguments for legitimate treasury company strategies. Like if you actually have a product or a company that produces reliable cash flows outside of your stock increasing. I just want to earmark one thing that he says here. One of the fundamental differences between these is that these actually theoretically should have been more insulated against a kind of unwind, because they were holding productive assets in a lot of cases. They were holding equities that pay dividends. They were paying bonds. They're holding bonds that pay an interest rate annually, right? And so you could actually pay back the investment trust, depending on how it's structured, the holders of your investment trust, if there's a dividend from the assets that you're holding. You can't do that with Bitcoin, right? Because Bitcoin does not produce a yield. But we'll get to that a little bit later. You wanted to say something?
No, I don't. I want to go back into this. Okay. Let's keep going.
So shades of the Cambrian explosion of the investment trust in 1929 are in the Bitcoin treasuries Cambrian explosion we're experiencing currently, this author argues. And he has a note here from James Chanos, who has been a very vocal opponent of these treasury companies. In fact, I'm pretty sure he's actively shorting Strategy currently.
Yeah, he is. He's famously shorting Strategy. He's talked about it publicly a lot, which is kind of interesting. My comment on that is, I don't know if like he has certain requirements, he needs like certain size or liquidity, but like we've talked about this before, of all the companies, I would not be shorting Strategy. I'd be shorting other companies, but okay, enough on that.
Yeah, that it is interesting. I think there's probably the fact that since Strategy is the largest of these and it has the is most heavily capitalized, there's so much liquidity in Strategy's market that the borrowing cost for shares to short is probably much lower than some of these other Bitcoin treasury companies. So maybe there's an argument that the other ones are so small that the borrowing costs are too high because there's not enough flow to the stock out there, that maybe it just doesn't make financial sense to do it. Also, maybe it's harder for him to short something like Metaplanet, which is traded in Japan. There are just extra hurdles there in terms of exchange rates and international banking laws. I don't know why he's shorting Strategy in particular, but his thesis is basically that we're reaching, an extremely frothy point in this market. And to just look at the number of treasury companies being launched now versus the investment trust, he has this tweet that puts that in context. Just remember from this quote from Galbraith, the $3 billion of investment trust securities that were marketed to investors in 1929 represented at least a third of all new capital issuance in that year. So a third of the capital issuance in the U.S. was coming from these investment trusts. That's crazy. And Chanos points out here, we were getting to the point where the Bitcoin treasury company's equity, this is a quote from one of his tweets, raises are becoming a material amount, 10% of the entire U.S. savings rate at $100 billion per month. At the peak of the SPAC issuance boom, which was in like 2021, SPACs raised about 180 billion for the LTM through Q2 2021, or 500 million per day. The Bitcoin Treasury Company raises are starting to get close to that level. And if we look at a tweet from Meltem Demours in the last,
she's all in on digital asset treasuries, or DATs, which is the more encompassing term for not just Bitcoin treasuries, but now the Ethereum treasuries and the Binance and the BNB treasuries. Yeah,
that's the inclusive term.
Yeah, the politically correct term.
Yeah, they're going to hop over to this tweet really quickly. She says, in the last 8 weeks, 98 companies raised or announced plans to raise 86 billion to buy crypto. Now, just to be clear, those are not raises that have all been realized. Those are raises that have been capitalized and raises that were announced. So prospective raises. I still think the point stands in terms of what we're trying to illustrate, though. Most have no revenue and minimal employees out of IR, FinOp, and legal. She says, I think it only gets crazier. Selling $1 for $3 and clipping 20% sponsor fees is too tempting. So she's kind of saying two things there, I feel like. She's saying simultaneously that this has room to run because the incentives are just too great. But at the same time, the incentives are too great. How long can this actually last? Right? And for right now, obviously, it's in full swing. But we'll go back to this article really quickly just to make a few more points, and then we can talk a little more free form about this for the rest of the episode. But B. Water says, today, Bitcoin treasury companies show a remarkably similar pattern. New entities are launched weekly as companies around the world race to replicate MicroStrategy success. The Bitcoin treasury Cambrian explosion is trackable in real time via bitcointreasuries.net, which we've referenced a lot. You can go there. I'm not going to read all the treasuries and the amount of Bitcoin held, but this just continues to tick up day by day in terms of how much Bitcoin these companies hold. I believe now it's like public listed entities in the US account for, we covered this last week, it's like over 800,000 it's about 900,000 Bitcoin, which I believe that number includes the ETFs, but it's still a pretty insane number.
Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin.
Another thread that B. Water plucks from this that we can see going back to the 1929 crisis is that all of the investment trust operators basically made the case that they were leveraging long-term debt intelligently. Sounds awfully similar, right? This is the whole speculative attack theory. It's you need to use debt and leverage it intelligently to responsibly accumulate Bitcoin, right? Because you're basically trading in something that we all believe is going to zero, dollar denominated debt and the US dollar. You're using these instruments to buy Bitcoin. But in this section called Intelligent Long-Term Debt, B. Waters says here, and I quote, this proto-MicroStrategy approach gave 1920 asset managers access to premium forms of leverage, corporate bonds with long durations, sometimes up to 30 years, rather than margin or call loans subject to immediate liquidation. These extended maturities theoretically allowed the trust to maintain leverage across the business cycle without facing immediate refinancing pressures, while their relatively low risks reflected widespread investor complacency and a systematic mispricing of risks. Lynn Alden makes similar observations about contemporary Bitcoin treasury companies. This is a quote from Lynn. Publicly traded operating corporations have access to better types of leverage than hedge funds and most other types of capital. Specifically, they have the ability to issue corporate bonds, often with multi-year durations. If they hold Bitcoin and the price dips, they don't have to sell prematurely. This gives them a better ability to weather periods of volatility than entities that rely on margin loans. There are still bearish scenarios that could force corporations to liquidate, but those scenarios would involve a much longer bear market occurring, thus making them less likely. And that's kind of the argument for MicroStrategy, right? You look at some of these converts that it's issued, the maturities for them are, I want to say like anywhere from 5 to 10 years. Don't quote me on that, but I've seen some that mature in like 2032. And the argument for that is they just continue to use this debt to buy Bitcoin. Bitcoin goes up, their stock price goes up, there's no way that the strike price on those convertible notes, i.e. the price that the issuer of the debt can then take the stock and then sell it on the open market. So if MicroStrategy is trading at $300 per share, if the convert has a clause for the conversion price being $100 million or $100 per share, then they're going to take that. They're going to capture the delta, right? They're going to arbitrage that. But if Bitcoin isn't doing well enough, then and MicroStrategy's price is down, then Strategy would have to pay back that loan. But the argument is that the terms are so far out into the future that the chances that Strategy will be trading below the stock price in the convert is basically nil. That's the argument. We obviously have not seen it play out yet because I don't believe any of these have come to maturity.
Yeah, and many of them are several years off, I believe. I mean, okay, maybe this is a crazy idea, Colin, but what if you were, say, like a real business that produces a lot of cash, which has a really good long-term sustainable business, and then you issue convertible shares, which don't surpass significantly the real enterprise value of your business, and you use that to buy some Bitcoin, and it doesn't become the exclusive and sole narrative of your company. Imagine that you have a real business, and then you actually do leverage this credit, long-term credit game. This to me actually sounds like a pretty reasonable idea whenever you dial it up all the way and you have non-revenue generating companies. Again, I don't really know. I'm not a student of the public markets. I don't really know how this stuff works that well, but like I do know companies do have to make money. It's kind of the point.
That's
so like, what if you have a company that actually makes money and then you start doing the Bitcoin play? This seems like an actually good idea to me.
Ideally, that is what a company does, is make money. And for these, preferred stocks that Strategy is issuing, the dividends have to come from somewhere. Typically, those come from company profits. We've done the numbers here before, and that's not possible, at least under current cash flows, for them to do that. That leads to the last 2 points that I want to make so that we can close out. This is a good jumping off point into the last 2 points from this article. First is the collapse of the trust in the 1929 crash. As I said before, these trusts were underpinned by a number of financial instruments, usually equities and bonds. And the idea here is that they were a little more diversified, so they should be resistant to any sort of systemic shocks, right, that might shake the markets. It got to the point where a Yale economist named Irving Fisher famously said that stock prices had reached a permanently high plateau. Sounds kind of similar to the way that some people were talking about Bitcoin never having a true bear market again. And he made the argument that these investment trusts were part of the reason why that plateau would sustain itself, because you had all of this buying pressure for these instruments, right? Well, ultimately, the piper wanted his pay, and the market started selling off. And turns out that everything in this massive bubble was tied to the credit cycle, and everything went down in tandem. So then you had these investment trusts unwinding. You had people using these investment trusts, to borrow money elsewhere and invest it elsewhere. So now these equities are worth less. That creates, knock-on effects and secondary effects in terms of liquidity crises and in terms of, unwinding some of these financial instruments. And you had these things collapse, right? And, investors lost a lot of money. The issuers, lost a fair amount as well. And one of the arguments that I mentioned earlier was this idea that, at least these things in perfect market conditions, as long as the assets themselves are not tanking, then you would reasonably expect for these things to maybe have more legs than a Bitcoin treasury company, because the underlying assets like equities and bonds pay some sort of yield or dividend, right? Bitcoin does not do that, obviously. And that leads to my last point, and to lead into the lead-in that you just gave me, is this idea that these Bitcoin treasury companies and their dividend structures are kind of looking a little pyramid-y. We're not going to outright call them a Ponzi scheme, but
it's a reverse funnel, Colin. It's a reverse funnel.
It's an upside down funnel, and we're going to use it to suck up all of the monetary value in the universe and inject it into the most pristine asset mankind has ever known. But anyway, Financial Times Alphaville basically intimated as much, said Saylor's latest strategy for strategy. This is a headline: selling new shares to pay dividends. And the excerpt for the headline is, "Isn't there a word for that?" Hinting at Ponzi scheme, obviously. So we covered this last week, I believe, but MicroStrategies or strategies for preferred stocks, I believe it's Strike, Stretch, Stride, and
Strife.
Strife.
Yeah.
Interesting word. Interesting word to use. Yeah. So these all pay a dividend, right? Strategies Q1 revenues were $111 million in that ballpark. The dividends that they are currently going to have to pay out are estimated to be $300 to $400 million annually. If you take out all other costs to run the company and just go from the revenue, you could cover this, but that doesn't cover payroll, doesn't cover services that they pay for, doesn't cover SG&A or anything like that.
Okay.
The basic idea is to keep this perpetual motion machine going, you're going to have to continually either take on debt in the form of maybe convertible notes or some other form of debt, which would be higher interest. So that's not ideal. Or you're going to have to continue diluting shareholders, selling shares to pay out dividends for your preferred stock, not to mention buying Bitcoin to keep the entire business running. So going back to your point, I think that we are going to get to a place, if the treasury bubble doesn't ruin it for everyone, where the market starts distinguishing between those companies that have cash flowing businesses like Tesla, but also hold Bitcoin on their balance sheet as a way to diversify away from, other forms of or other financial instruments that they might hold on their balance sheet, right? And I think that, to your point, that makes a lot of sense to me. If you're a cash flowing company, you might even be able to swing it to where you issue some of these preferred notes or preferred equities to pay a dividend to accumulate more Bitcoin and invest in your business. And as long as you have those cash flows coming in, that model can work. But the only way that the current model works for a pure play Bitcoin treasury company is Bitcoin has to continue to go up, and you have to get increasingly creative about the kind of financing you're chasing. And then that creates other complexities because at first you're just going
to be pushed further out on the risk curve. Exactly.
Exactly. Because if your strategy, you started out with converts, for what you're doing, relatively low risk, as long as Bitcoin keeps ripping. Obviously, everything's contingent on Bitcoin ripping. But then you add the preferred shares in here, and now you have a dividend to pay. So now you have to figure out where you're going to get that cash. And
one of the interesting things, Colin, is that, again, I'm not an expert on Ponzi schemes, but a lot of Ponzi schemes rely upon the opacity of the actual Ponzi. So, like, the participants aren't able to look at the obligations of the Ponzi at large. They're not there. It's hard for them to like audit. Oh, this is financially unsustainable. They're like, I'm getting paid, and that's like that. It's like, and my boy, he's been writing me checks. I've been working out for me, and so with public markets, we can see the balance sheet. We know it's all there. It's both on chain and in their 10Qs or whatever those documents are called. And so like this is interesting because we have kind of a
transparent Ponzi scheme.
Yeah, it's very out in the open. So like that is one way I think that this differentiates.
Yeah, for sure.
And then just another point which is unrelated to that, which is a lot of people are like, okay, well, how does it, you explain the problem with it. The way it unravels is actually pretty simple. These companies at some point, if Bitcoin goes down enough, their share price goes down enough, they have to sell Bitcoin, they have to sell their treasury to pay out. And then they become forced sellers of Bitcoin even when they do not want to. And this is one of the things is like Bitcoin hasn't had a whole lot of forced sellers. It's typically typically been driven by the lack of buyers. So whenever we have interesting leverage like this, where we have forced sellers, that can then create a reflexive feedback loop where company A is forced to sell, the price of Bitcoin goes down artificially below its like real demand. Company B, that's their threshold. Then they have to sell. And then it's a study in cybernetics and feedback loops, and it becomes this downward force. Does that happen in the next few years? Even it's really, really hard to say. We actually have the easy job, Colin. We have the easy job of saying something's going to go wrong,
but here's
how it will probably go wrong. But nobody cares about that. People care about the timing, because you can be right and have the wrong timing, and you are wrong. And so I currently am empty-handed for timing, except not in 2025 is maybe my only.
Yeah, I think that's one of the things that's split along the kind of bearish Bitcoin treasury camp is when exactly you would see this unwind. A lot of people make the argument that we probably wouldn't see cracks even until like 2028 or between 2028 and 2020 and 2032, because that's when a lot of the converts for master. There's the ticker MSTR, the ticker MSTR for strategy, right? Because that's when some of these converts are due. And you have a lot of ways or a handful of ways that these things can unwind, right? Because there's the obvious one with strategy where if the share price isn't above the convert price, then they're going to have to pay that debt back. And the only way they can do that is by selling Bitcoin or raising more money, which they would be hard pressed to do if they're already in financial straits. But, there's also an element of maybe you're a treasury company that's only using equity to finance your buys and you're just diluting all the time. If you get to a point where Bitcoin crashes and your net asset value is dipping below 1 and no one has faith in your stock, then if your stock price suffers and you can't pay the bills, what happens? Do you end up selling Bitcoin, doing a stock repurchasing program? Do you end up trying to salvage the business by selling that stack off somehow and paying operating costs? Or do you go into bankruptcy and then eventually those Bitcoin are going to get sold off in the liquidation process? So there's a number of ways in which this can unwind, but all of it really, I think, leads back to at what point does the system become so over-leveraged with these things, and hopefully, this is going to happen and it is happening, but you'd like to avoid it. How much are these instruments being used to collateralize other financial agreements, right? That was a big part of why.
Yeah, because that's what caused DCG, because DCG just had their money in Three Arrows Capital, and then that contagion spread to real assets like their Genesis mining, which we covered on the mining pod during that time. Yeah, when so far I don't see that that this is being leveraged out as collateral outside of just like the pure stock, but like at some point it does.
Yeah, 100%.
It gets there.
So yeah, I'm starting to come around to the camp that this is not something that's going to be net good for Bitcoin in the long term. I think that bubbles can last longer than you think, but ultimately, like eventually, like everyone has a price that they're going to sell at. And if you've got a lot of debt and leverage behind this thing, then that's, a recipe for disaster. But that's my final take on it. I just hope that we can still have the music go a little bit longer before the chairs.
Yeah, I want the music to play as long as possible. This is the two sides of Bitcoin Season 2. We can both, like Babe Ruth, call the shot and say, yeah, this is going to happen. But at the same time, we're going to have fun swinging, because it's something visceral inside you loves to see the number go up. It is so much fun to even just stand outside the casino and smoke a cig and kind of look at all the fun happening inside. It's fun. So, well, shout out to all those people. And we will be covering more paper Bitcoin stuff. This is not exclusively a paper Bitcoin bear show. This is we are the screenwriters of this show. And so we're trying to write the most entertaining plot as possible. So without further ado, thanks for listening to Bitcoin Season 2. Catch you all next week. Hey everyone, Charlie here. We're running a quick survey. We want to better understand who our listeners are. Do me a huge favor and fill out that survey. It takes under a minute, and the link is in the show description. This helps us make better content for you. Thanks a ton for listening. Link in the show notes.